Hi everyone, my name is Sharon, and today for my video tutorial number 2, I'm going to be focusing on balance of payments in chapter 6. So you might be wondering, what is balance of payments? The balance of payments, also known as BOP, is a method countries use to monitor all international monetary transactions at a specific period. So usually the BOP is calculated every quarter in every calendar year. All trades conducted by both the private and public sectors are accounted for in the BOP to determine how much money is going in and out of the country. So, for example, if a country has received money, this is known as a credit. And if a country has paid or given money, the transaction is counted as a debit. It's pretty straightforward. It's almost as if you were to pay with your debit card or if you were paying with your credit card. So theoretically, the BOP should be 0, meaning that the assets known as credits and the liabilities known as debits should be balanced. But in practice, this is rarely the case. Thus, the BOP can tell the observer if a country has a deficit or a surplus and from which the part of the economy the discrepancies are stemming. Some key takeaways are the balance of payments is the record of all international financial transactions made by the residents of a country. So that's what I just mentioned previously. There are 3 main categories of BOP: the current account, the capital account, and the financial account. The current account should be balanced versus the combined capital and financial account, leaving the BOP at 0, but this rarely occurs. The balance of payments divided. So the BOP is divided into 3 main categories, as I just mentioned: the current account, the capital account, and the financial account. Within these 3 categories are subdivisions, each of which accounts for a different type of international monetary transaction. Starting off with the current account is used to mark the inflow and outflow of goods and the services into a country. Earnings on investments, both public and private, are also put into the current account. So the BOT is typically the biggest bulk of a country's balance of payments, as it makes up the total imports and exports. If a country has a balance of trade deficit, it imports more than it exports, and if it has a balance of trade surplus, it exports more than it imports. Moving to the capital account is where all international capital transfers are recorded. This refers to the acquisition or disposal of non-financial assets. So, for example, a physical asset such as land and a non-produced assets which are needed for production but have not been produced, like a mine used for the extraction of diamonds. They're broken down into the monetary flows branching from debt forgiveness, the transfer of goods and financial assets by migrants leaving or entering a country, the transfer of ownership on fixed assets, the transfer of funds received to the sale or acquisition of fixed assets, gift and inheritance taxes, death levies, and finally, uninsured damages to fixed assets. So lastly, we're going to be focusing on financial account. In the financial account, international monetary flows related to investments in business, real estate, bonds, and stocks are documented. Also included are government-owned assets such as foreign reserves, gold, special drawing rights, so SDRs, held with international monetary funds, which are known as IMFs, private assets held abroad, and direct foreign investments. Assets owned by foreigners, private and official, are also recorded in the financial account. So they talk about net change in the U.S., assets owned abroad, and also foreign-owned assets in the U.S. So I've attached a diagram to better explain the balance of payments, because I feel like with a visual representation, there's a better understanding to it rather than having words being thrown at you. So the main question is, does it create a future obligation or is it current? And if we were going through the future route, you would ask, is money coming into the country or going out? If it were coming in, it would be a credit, which means selling bonds to foreign entities and savings sent from other countries. And if it were going out, it would be a debit, which is buying bonds from foreign entities, which is savings sent to other countries. And if you were going through the current route, you would ask, is money coming into the country or going out? If it were coming in, it would be a credit as well, and it would be export goods or services and remittances received, factors income earned abroad, and if you're going out, it would be the total opposite. So instead of exported, imported. Instead of received, paid, and instead of earned abroad, it would be paid abroad. So that is the main gist of it all, and thank you for watching.